Hey everybody, this is Paul. I wanted to make a quick video, more of an educational type video to post on my channel here, but a unique um, type of bond instrument that I've been seeing recommended lately on different Reddit forums. And I wanted to go over what this is, um, uh, how does it work, what is it, how would I go about using something like this. Um, So what I wanted to do was go over where I discovered this at, how it works, any downsides potentially to it, and just you know, why you might want one of these, why you might not want one of these. This is not a sponsored video. This is just something I saw. So if you ever go on Reddit for different advice, so if you go to say, there's three separate forums that are mainly used. So there's Wall Street Bets, which many of you have heard of. There's r/investing, and then there's r/personal finance. If you go into any one of these forums and you say, I have $50,000, where should I invest it? If you go into Wall Street Bets, they're going to give you probably something really risky. They're going to say, uh, you know, GameStop, all 100% of it, go all the way in, whatever the most risky things are. So you either make $1 million or you go straight to zero, and your chances of going to zero are very, very high. If you go to r/investing and you say, I have money, they're going to tell you about Roth IRAs. They're going to tell you about ETFs with low fees on them. They're going to tell you about dividend type portfolios. They're going to tell you about the best brokerage to go with, that type of thing. But if you go over to r/personal finance, you actually get a different answer. And it's an answer I've never seen recommended before, because the normal knowledge, or if you want to say it like that, currently is that, bonds are bad. Um, you know, and I can show you why everybody says bonds are bad, because normally the idea of a 60-40 portfolio, 60% stocks, 40% bonds, or 70% stocks, or 30% bonds as it is now, has been recommended for 40 years, 30, 40 years or something like that. But as interest rates have slowly gone to zero, this has fallen out of favor, and you see more and more people going basically 100% into the stock market, you know, far later than you would normally do. If you ever look at a target date retirement fund, in theory, those are supposed to go into bonds at some point. So what's been happening is more and more people are getting more and more stock exposure, so the market's going up. um, Boomers are, doing crazy portfolios where they have very big exposure to the market. So, and they're supposed to be retired. So what is going on? You know, why would you look at this type of bond? Like why? Like what would be the point of this, or why do people recommend this? So what is a Series I bond? So a Series I bond, and I want to read this directly off of Investopedia. Series I bond is a non-marketable interest-bearing U.S. government savings bond that earns a combined fixed interest rate and a variable inflation rate adjusted semi-annually, so every 6 months. Series I bonds are meant to give investors a return plus protection on their purchasing power. Most Series I bonds are issued electronically, which I'll show you where it's at. And then a Series I bond is non-marketable interest-bearing U.S. savings bonds. So what this part means right here is you're not going to see an ETF with a bunch of Series I non-bonds in them. There's not an ETF out there that's like, at least I don't think there is. I searched, but I couldn't find any. There's not one. This is made for individuals, and it's capped at $10,000 per year. The bonds cannot be bought or sold on the secondary market. That's also what that's talking about. They're in a fixed interest rate for the life of the bond and a variable adjusted each May and November. So what this is, basically it compounds monthly, and then every 6 months the interest rate change. And I'll show you an interest rate chart and explain how that came up with that. Um, And then this is more information. I'm going to link this site so that you can read it. So this is the calculation that they use. So the fixed rate, which is set by the Fed, which is currently 0 to 0.25, but that might go up next year. And then you do 2 times the semi-inflation rate, and then you take the fixed rate times the semi-inflation rate, and then you get. So this is showing a calculation of how that would work. Given these different types of things here. So why would you do something like this? What would be the point, right? Because the normal knowledge, or the common knowledge, at least for millennials and Gen Z, is everybody's been telling you to go into the market. This question normally comes up when somebody's saying, "Hey, I want to buy a house in 5 years, and I need a safe place to put my money that I know it will be there in 5 years." So if you know anything about the market will go up, the market will go down. The problem is if you have a set date that you need to pull a large amount of money out of the market, and you need to know that that money is going to be more than what you put in, depending on who you talk to, some people will say, well, yeah, put it in the market no matter what. Well, what happens if you put the money in the market, say, at the beginning of 2018, and you said, I want to buy a house at the beginning of 2020, and I have to have that money out by the beginning of 2020 because maybe that's when I graduate school, or maybe that's when my wedding is, or something, or I'm having a wedding. Well, if you try to pull your money out in March of 2020, well, now all of a sudden you're down 30%. And the market was trading kind of flat for most of 2018 and 2019, if you kind of look at the charts. So you might sit there and say, oh, well, damn, now I got to set my whole life plans back 6 months, hope the market recovers. Well, who would want to do that? So what these are a way of basically picking up to $10,000 in 1 year. So you could do $1,000 a month if you wanted to have a ladder strategy, which means you have one that's, expiring every month or so. Or you could do $10,000 all at one time, but it's within a tax year. So it's within so I'll link these sites for sure. So these shows you the different things. So if you do the electronic one, it's a minimum purchase of $25. Most you can have in a year is that for an electronic one. And you do that right on this website. This website is treasurydirect.gov. This is run by the government. So how do taxes on this work? So you have to hold it for a minimum of 1 year. Then you can redeem it. If you redeem it before 5 years, you forfeit the interest for the previous 3 months. After 5 years, there's no interest penalty. You don't give up any interest whatsoever. Interest earning period 30 years until you cash them, whichever comes first. So it's literally a 30-year thing. And then you have the option, it's in here. They do give you the option of you can pay normally you would pay the interest once you redeem it. So if you redeem it in 2 years, then you would pay the interest or the gains, the capital gains tax that you owe on it for that tax year. Before you buy one of these, talk with somebody who's actually a professional on this. I'm just doing kind of an educational video to kind of let you know that these do exist. There is a lot of information on here. And it's a very useful resource. There's a large amount of information on here. So what is going on? Like why, what's the point of these? Like what's the downside? What's the positive side? So if you look at this chart, it starts right here and then it starts changing every 6 months. So what's going on this chart? On this chart right here, you have pre-China going into the WTO. So this is back when we had a Federal Reserve that had interest rates that were high and we had inflation that was actually relatively somewhat high. China joins the WTO in here in 2001. We start importing deflation from all around the world. So our inflation rate starts going down. So even though the federal funds rate was going up through this period right here, actually right in here, we were importing deflation. That's what it's called. So our inflation rate was going down, so our products were getting cheaper. Right about here, the economy crashes. Right in this area right here. Fed funds rate goes down to 0. Inflation flatlines. The Federal Reserve cannot get it back up to 2% to save their lives. For 10 years, or actually for 8 years or so in here, the Fed funds rate sits at 0 and the inflation rate sits close to flat. So that's what this part is right here. Fed starts raising their rates again, inflation stays low, 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 and we get to 2020, or we get to right about here, in here, Fed realizes, uh-oh, the market's not doing so good, we need to start dropping rates again. COVID hits right about here, we end up back right where we were for the last 10 years, basically. So, if you'll notice, 7.12 seems to be kind of like the bottom on where this thing can go, unless the Federal Reserve actually goes negative one day, which will do some interesting things to that formula, which the Fed says they'll never go negative. Or we ever get negative inflation, which some economists may tell you is possible. But as it stands right now, come next year after this date right here, the Fed is supposed to, in theory, raise rates, which may take this rate back up to here, maybe in here, or something like that. And we have this high inflation rate, which may or may not stick around. But what you really need to focus on is the 7.12 number, because this seems to be kind of the area where this will stay around, unless some very different things change. So this is just a chart you can look at, make a decision, get a general idea of where this thing's going to adjust every 6 months. It's going to stay in this area, I assume. But if the Fed ever does go back to what's considered actual normal, and we actually get a balanced budget someday again, maybe you'll go back up to 10%. You never know. So why wouldn't you do this? Why wouldn't you do this? Okay, so why wouldn't you do this is pretty simple. If you look at so if you go to any performance thing, you take it out to 3 years. If you bought a Series I bond here, you put $1,000 in right here, and then you wanted to redeem it today, you have missed out on 121% worth of gains in the NDX. Or 40% in the Dow, 71% in the SPY, but this is a very, very unique period in the market. So this is why you don't see a lot of portfolio managers recommending these. Also, you have to hold them for a year. You can't roll them up into instruments like ETFs. So if you look at a lot of portfolio managers or somebody like that, they've been recommending high quality credit. That's just another way of saying corporate credit, because they're not recommending these types of bonds anymore. So they're not recommending this anymore. If you go here, this is the Vanguard Total Bond Index. This thing has a massive amount of money in it. 83 billion in assets with a 1.91% return rate. That's lower than any dividend rate. So what a lot of people have been doing is they've been going into here. This is the high yield corporate debt, 4%. But if you go to the portfolio rating on these, made up of very literally junk debt, basically. So basically junk bonds at the highest interest rate that you can find. So, so you can see what happens whenever our economy decides that it wants to tank. You go out 3 years. This was here, $88, and then it went all the way down to $70. And then it started to go back up as the Fed went in and literally started buying bonds. But this could have kept going down. The day that this went down, it was pretty bad. So, if you look at it right here, it had a volume of 18 million, kind of trade in that range. And then all of a sudden, on the day that this went down, it was 54 million. And everybody got out of it ASAP as they thought the economy was going to completely implode. So, You can see how these react. I believe BND did something similar. I can check. Oh yeah, look, BND did the exact same thing. So went to 87, dropped to 82. So if you had to buy a house, get married in this area, if you had a kid that you wanted to send to college and you needed the money right here, well, are you going to delay your kid's college? No, you're going to, it's kind of like you would have to pull the money out. So what these are mostly used for, or at least I've seen them recommended for, something that is a set expense, like buying a house and you need the money, a wedding type thing where you don't want to change the date. Maybe a kid's college. And the thing with college and education specifically, by the way, is there are special exemptions specifically for entrance earnings may be excluded from federal income tax when used to finance education. These things are extremely useful for education expenses, it looks like. So that's one thing to consider. So what I wanted to do is definitely just put a video together just to get the information out there. If anybody has any corrections to anything I've said, if you think I said anything wrong, please do let me know in the comments section. If you want to add anything, add it in the comments section. I just wanted to get these information out here about these extremely useful instruments. I may end up putting like say $1,000 in here and just letting it mature. It's literally a 30-year bond that just matures over time. So, may just put these in here and you buy them directly through the site, or treasurydirect.gov. I'll include all of these links so that you can look into this yourself. Like I said, if you're doing this yourself, maybe speak with an accountant first before you do it, um, and see what they say. But hopefully you may be able to find these useful and maybe able to get some, a different type of investing done that's not exposed to real estate, for example, that, could have problems, or is exposed to, some private equity thing, or the lending market, that type of thing. But this is like a different type of income that compounds monthly, so at a 7% interest rate. So let me know if you have any questions, and I thank you for listening to my video. Have a nice day.